I made around 4,000 euros this year investing in the stock market. I was a total beginner. I didn't do any deep research on it, neither did I spend considerable time on it. I just bought a few equities which I thought will bring considerable profits in the long term. But then I started to think why I didn't invest earlier. And the simple answer was I didn't know where to start. I always thought this whole investment thing was reserved for those investment gurus or the wolves of Wall Street. And this is a very complicated world and I should probably stay away from it. I couldn't have been more wrong.
Listen, I quit. Yeah, I'm going into stock.
If I can do this, then probably you can do this too. You just need to know the 5 key terms. That's it, the 5 key terms which tells you what to buy and when to buy. Hey friends, my name is Srijit and welcome to The Journey. In this channel, we talk about strategies and tips to become financially independent and live the life the way we want. If you have watched the previous videos in the channel, you might already know about the history of stock and the stock market. Stocks are also called shares and they form the basics of everything we do in the stock market. Stocks are ideally stakes in a company, and when you own a stock of a company, you are technically owning a piece of the company. And as the company grows, so does the value of your stock. And when you sell them at a higher price than the price at which you bought, then you make profits. But all stocks are not the same. The benefits you get and the profits you make depend on the type of stocks you buy. Ideally, all the stocks can be classified based on 2 categories. One is market capitalization and second is the type of returns. Market cap is ideally the value of a company determined in stock market terms, and calculating the market cap is totally easy. You just have to multiply all the shares of the company with the value of 1 share. For example, if a company has 1 million shares and the value of 1 share is $10, then the market cap is $10 million. You might have probably heard recently that the Tesla became a $1 trillion company.
Tesla has hit $1 trillion market value.
Now, Tesla has surpassed a market value of $1 trillion.
What they ideally mean is that the market cap of Tesla has recently reached $1 trillion. And based on this, all the companies can be classified into 3 categories: small cap companies, mid cap, and large cap companies. All the small cap companies fall between roughly $300 million and $2 billion in market cap. And the stocks from small cap companies are often highly volatile. So that means the value of stock can fluctuate a lot. And the mid cap companies are those with a market capitalization of between 2 billion and 10 billion US dollars. And large cap companies are those with a market capitalization of more than $10 billion. And stocks in this category are frequently referred to as blue chip stocks. Large cap stocks are generally considered safer than the small cap stocks. But the small cap stocks have a much higher growth potential. We can ideally compare them to trees. In a big storm, a giant redwood tree will hold up well, but a small oak tree will have a rough time. But the redwood may not have much growth left, but the small oak tree has plenty of growth to look forward to. Although market cap is an important factor to consider, it is just one measure of value. A more appropriate metrics to choose the type of stock could be based on how you want to get your returns. And based on how you get back your money, the stocks can be classified into dividend stocks and growth stocks. When publicly traded companies make profits, they normally reinvest the profit into the company to grow faster. This could be for buying new machinery or employing more people. And the stocks of those companies who are more focused on expanding and developing the business are called growth stocks. Classic examples of growth stock include companies such as Meta, previously Facebook, Amazon, and Netflix. Then there are those companies which, instead of reinvesting all the money into the company itself, they distribute a share of the profit to the shareholders. And this share of the profit is called a dividend. This could be done monthly or quarterly. And the stocks of those companies which offer regular dividends are called dividend stocks. Good example is Coca-Cola, the soft drink giant that has been paying dividends to its shareholders consistently for the past 59 years. And then there are stocks from companies like Apple, which are basically both growth and dividend stocks because they offer you some dividend, but the major part of the profits are reinvested back to the company to expand and grow. A dividend could be a good source of passive income to build a constant source of revenue. Stocks are the most direct form of investment and you have direct control over where your money goes. But investing in individual stocks require a bit of knowledge and understanding of the company and its future prospect. And this might take some amount of your effort and time. A lesser time consuming option for a beginner investor could be funds. A fund is a collective investment where someone pools money from many people and then invests together in the stock market. You can think of it as a company that collects all your money and then buy shares with it. And the funds are managed by fund managers, and they assess the various investment options available and decide on where to invest. That means less work for you and more work for the fund manager. And then nothing comes for free. So you have to pay a price for the effort the fund manager puts into managing your investment. A major advantage of funds is that you can start at very small amounts. Suppose you want to buy the stocks of the company Berkshire Hathaway, run by the investor giant Warren Buffett. Class A shares of the company cost around $400,000 each. Most of the small investors like me might not have that much money available to buy one stock of Berkshire Hathaway. So in this case, the only option left would be to invest in a fund which contains the shares of Berkshire Hathaway. Another big advantage of funds is that your investment is automatically diversified. You can buy an emerging market fund and then your money is split into different sectors and different countries in that market. So if the travel sector is down due to a pandemic, these companies will suffer losses, but the other companies like pharmaceutical in your funds will compensate for this loss. The best option for a beginner investor and a more popular option nowadays are exchange traded funds. They are very similar to funds, and your money is collected, divided and invested in the top companies listed in a particular stock index. For example, the S&P 500 ETF tracks the performance of 500 largest companies in the US stock market. I will talk about indexes shortly, but just know that the ETFs automatically follows an index and doesn't need to be actively managed by a fund manager. So it could be a cheaper option compared to the normal funds. Stocks and funds have the associated risks, and there is no 100% guarantee that you can make profits from your investments. And for those security conscious investors, an ideal option would be bonds. Bonds are seen as a more secure investment option where companies or state borrow money from you. Ideally, you act as a bank providing a loan to a company or a state and get an interest in return. This is very similar to when you take a loan from a bank. The interest rates are fixed at the beginning and it is usually paid out annually, and after the end of your term, you get your whole money back. The only risk here is that the state or the company could go bankrupt.
General Motors is expected to officially file for bankruptcy tomorrow morning.
JCPenney filing for Chapter 11 bankruptcy.
And since this is a very less probable scenario, the risk associated with bonds are very less. But then the interest rates and the final returns are also less attractive. I don't personally have much investment in bonds because in the current financial situation I am in, I can afford to take a bit more risk for more profits. But it might be totally different for you. So based on your current situation, bonds may be a good option for you. Owning the right investment is one thing, but knowing how the market is performing and when to make your trade is another. So there are three key terms in play here: market index, bull and the bear. If I ask you to give me a real-time situation of the traffic in your city, how would you do it? You are unlikely to go to every junction and road in the city and check the traffic flow. Instead, you would probably concentrate on a few major roads and highways and make an assumption based on that. Similarly, to understand how the market is performing, we don't have to assess the individual performance of each and every company in the market. It would be enough to check on few major companies across some key industrial sectors. So if the values of these companies are going up, then we say the market is going up, and vice versa. But how do we decide on which companies to monitor? There are specialized organizations which work on creating this cluster and continuously monitoring this company. And finally, they assign a value based on the combined stock value of these individual companies, and that final value is called the market index. A major stock index is the S&P 500, which tracks the 500 leading publicly traded companies in the US. This index is maintained by the global credit rating agency Standard & Poor's, and hence the name S&P 500. Normally when people say the market is going up or down, they are generally referring to one of the major market indexes. But an easier and a more common way to express the movement of market is through two animals, the bull and the bear. You might have probably heard statements like market is being bullish today, or we are in a bear market.
Thinking we're in a secular bull market.
The S&P 500 falling into bear market territory.
The bull represents the growth of the stock market and the bear represents the downward movement of the stock market. It's said that the terms came from how these animals attack their opponents. So the bull will normally thrust its horns up in the air while the bear will swipe down. In other words, a bull market means that the assets in the market are increasing the value and the investors are confident and optimistic. And similarly, a bear market means that the prices of the assets are going down, the investors are feeling pessimistic and pulling back. According to Dow theory, if the prices have gone down at least by 20%, we are in a bear market, and if the prices go up by 20%, then the market is bullish. But the good news is that the average bull market far outlasts the average bear market, and that is why you can make profits if you invest for a long term. The formula to be successful in stock market is very simple. You buy when the prices are low and you sell when the prices are high. But it's very difficult to keep a strong face and control your emotions when everything around you is tumbling down. But for someone who is looking at the long term, if you can control your emotions, then bear market is an appropriate time to buy some stocks at lower prices. Now all you need to do is put your money to work. And to know how to do that, you can check this video where I explain step by step on how to start trading with a broker. Being in the game is more important than being the master of the game. So start playing. Until I see you in another video, stay safe, stay happy. Ciao.